Hey everyone, Snowflake gave investors a quarterly financial update, and I wanted to take this opportunity to update my recommendation of Snowflake stock. Coming into this quarter, I had Snowflake stock rated as a hold or not rated as a buy. I'm going to update that recommendation, but first I'm going to share with you the big picture items from Snowflake's latest investor update. And then I'll share with you what I think of the stock longer term and whether or not I think it's a buy, hold, or a sell. So let's get started. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, so Snowflake has an interesting business model that I wanted to review with you first. The starting point for Snowflake is booking sales or booking customers. Right, they'll engage in negotiation with their customers and they'll sign a deal. Let's say 3 years, $100 million, whatever the case might be, or 3 years, $10 million. Okay. So typically, Snowflake's customers pay annually in advance. So that's their billings. Since they have variable billing terms, billings are not necessarily indicative of future consumption patterns. Some customers might pay their full annual bill upfront. Some customers may prefer monthly billing. Some customers might prefer quarterly, whatever the case might be. Remaining performance obligations, RPO, represents contracted future revenue not yet recognized. This is a huge number for investors to consider if they're looking at Snowflake stock. This is the total cumulative value of all the contracts they have signed but not yet served. So if they sign a 1 year, $100 million contract and we're 6 months into the year, they have $50 million left in that contract. That's going to turn into revenue over the next 6 months. Okay. So that's why RPO is so important, because it represents value that's going to turn into revenue. It hasn't yet turned into revenue because Snowflake first needs to deliver on that contract. So revenue is what the company delivered in the current quarter, but I think investors looking at Snowflake stock should focus more on remaining performance obligation. I would say a little bit more than revenue. I would say 60-40. Pay 60% attention to RPO, 40% attention to revenue in terms of measuring the company's top line performance. All right, so let's start with the company's revenue. In its latest quarter, which is its first quarter of fiscal year 2025, the company grew revenue by 33% to $829 million. This was up from $624 million in the same quarter the prior year. Now, looking at annual growth, you have a nice picture of Snowflake's revenue growth here from $1.2 billion in fiscal year 2022 up to $2 billion in fiscal year 2023. Up to $2.8 billion in fiscal year 2024 for 36% growth year over year. And you'll notice that the latest quarterly revenue growth is a slowdown from the previous year annualized revenue growth figure. And that's been the story with Snowflake in recent years, is their revenue growth rate has been decelerating. And that story of deceleration is also true for its remaining performance obligations, which is one of two noticeable headwinds I saw in Snowflake's latest quarter. So you'll notice here, first quarter fiscal year 2025 remaining performance obligations decreased to $4.988 billion. That was down from $5.175 billion in the previous quarter, which was Q4 2024. Comparing to Q1 2024, it's much higher, but since this is a cumulative number, it makes more sense to compare it with the previous quarter, which it experienced a decrease. And what this means is Snowflake delivered more performance or more service in the current quarter than it signed for future quarters or future periods, right? So in the current quarter, it served more customers or served more customer value than it signed for new customer value. And so overall, the RPO decreased because more revenue was served, more revenue was earned than was signed. And that's not a good sign. especially when you have a company like Snowflake that's already demonstrating decelerating revenue growth. And then you notice that RPO in the quarter decreased, and that's just more signification that future quarters revenue growth is likely to continue decelerating, which is not great news. It's not great news, especially because Snowflake is not a cheap stock. It's trading at a price to free cash flow of 65. So when you're trading at a price to free cash flow of 65, then you're under greater scrutiny because investors paying this high a valuation are expecting phenomenal results. And if you're not delivering phenomenal results, every single thing is going to be under a microscope. And that's what's going on with Snowflake. And that's why the stock price has been under pressure. In the last 5 days, it's down 5.85%. Investors were not happy with this earnings release, partly because of RPO that I showed you. The next thing I'll show you a little bit later is also another reason why the stock price was down following the earnings release. I've been paying attention to for several years now with Snowflake, and that is the net revenue retention rate. This measures how much existing customers spent with you this year compared to the prior year. So let's say, for example, you have one customer that stayed with you for 2 full years, okay? How much money did they spend on the second year versus the first year? Did they spend more? If they did, this number would be over 100%. If they spent less, this number would be less than 100%. So for Snowflake, this number came in at 128%, which means existing customers increased their spending with Snowflake by 28%. In and of itself, that's a good number. That means that customers are spending more with Snowflake, which signals that they're getting good value from Snowflake. That's why I look at this metric so intently, is because one of the things I look at when I'm evaluating a business is their customer value proposition. And one of the ways I measure that is through the net revenue retention rate. If customers are increasing their spending with you, that means you're offering them good value. Otherwise, they wouldn't increase their spending with you. They would say, we don't like what we got with the money that we spent, so we're going to decrease. Right? But if they liked what they got and they felt like they got good value and they want more of it, they'll increase. And that's what you're seeing with Snowflake. My trouble here, and again, I always highlight that I'm being picky with Snowflake because it's so expensive. My trouble here is that Snowflake's net revenue retention rate has been declining for several consecutive quarters now. Look back here, Q4 2022, it had a net revenue retention rate of 179%, down to 175, 172, 166, 158, 151, 42, 35, 31, 28. That's 1, 2, 3, 4, 5, 6, 7, 8, 9 consecutive quarters of decreasing net revenue retention rate. Even though the actual rate is still good, over 100%, 128, but the fact that this is decelerating so significantly and for such a prolonged period is a concern for Snowflake stock investors. Now, it wouldn't be so concerning if the stock wasn't this expensive, okay? If this stock was trading at a price to free cash flow of half of this, I wouldn't be so picky about the trend line of the net revenue retention rate. So considering those two big headwinds for Snowflake and the still expensive valuation, to update my recommendation of Snowflake stock, let me make this bigger for you so you can see. I had it rated as a hold coming into the quarter. I'm updating this recommendation and keeping it rated as a hold as of today. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.